Hey everyone, welcome back to Corporate Decoder, the place where we unpack the secrets hidden in corporate filings to see if these companies are actually on solid ground or just building castles in the sky. Today we're looking at Allegro Merger Corp, and let me tell you, this filing is packed with some pretty interesting maneuvers. It looks like a company is trying to make a big move, like a sort of merger or acquisition is on the table. So we're going to break down what that actually means for everyone involved. Before we dive in, if you like getting these financial deep dives without the corporate jargon, make sure to subscribe to the channel and join our Discord community, linked in the description below. We're building a great community of smart investors there. So what we have here is Allegro Merger Corp, a company that seems to be undergoing a significant change. They're entering into this big agreement called a merger agreement with another company called SeeQC Incorporated, and also a subsidiary of SeeQC called SeeQC Merger Sub Incorporated. Basically, Allegro will merge into SeeQC's subsidiary, and in the end, Allegro will become a wholly owned part of SeeQC. This isn't just a simple handshake though. It is a formal agreement that sets out all the terms and conditions for this major business combination. Now, what is really interesting is how they plan to make this merger happen, and what happens to all the different kinds of shares and ownership stakes. Think of it like a puzzle with pieces that need to fit perfectly. First, SeeQC's existing preferred stocks will automatically change into their common stocks. This is called a mandatory conversion. Then right before the merger happens, SeeQC will do a stock split. This means they'll divide their existing shares into more shares. The goal here is to make sure that after all these changes, the holders of SeeQC's common stock end up with a specific number of shares, a total of 200 million shares, plus any shares that might come from other types of investments called derivative securities. Even the stock options and restricted stock units that SeeQC has will carry over, but they'll be adjusted because of this stock split. For Allegro shareholders, it is a bit different. Each share of Allegro's common stock, and even their rights, will essentially be cancelled and converted into your right to get a share of SeeQC's common stock. It is like trading in your old chips for new ones. There is also a twist for Allegro's warrants. These are like options to buy Allegro stock in the future. The plan is to change these warrants so they will turn into the right to receive a fraction of a SeeQC common stock. If this change doesn't happen, SeeQC will just take over those warrants when the merger is complete. Now here is where it gets really interesting and a bit like a game. Some people who own SeeQC stock or had certain stock. Related awards called equity compensation awards will get extra shares of SeeQC stock, but this isn't a guarantee. They'll only get these extra shares if SeeQC's stock price hits certain targets within a specific time frame after the merger. They call these earn-out shares. For example, if between the closing date of the merger and the first anniversary of that date, SeeQC's stock price averages a certain amount over 20 days within a 30-day period, they'll get an extra 20 million shares. There are similar targets for the second and third anniversaries with higher stock price requirements for more shares. This is a way to tie the success of the deal and the future value of the company to the people running it. It really incentivizes them to perform. There is also something called Allegro Sponsor Restricted Shares. This applies to the early investors or founding shareholders of Allegro. They've agreed that a portion of the SeeQC shares they'll receive will be locked up, meaning they can't sell them immediately. These shares will be released from the restrictions based on whether those SeeQC stock price targets are met during those earnout periods we just talked about. If those targets aren't met by the end of the third year, any remaining restricted shares will be forfeited and cancelled. This is a strong signal that these early investors are betting on SeeQC's future success and are willing to have their own money tied up until that success is proven. Every deal like this involves a lot of promises and guarantees. The merger agreement includes what are called representations and warranties. These are statements made by both Allegro and SeeQC about their businesses and their legal standing. They're essentially saying, hey, this is the truth about us. These promises are important because if they turn out to be false, they can have legal consequences. However, in this case, these promises don't typically last after the deal is done, except for cases of outright fraud. Then we have covenants. These are like the ongoing promises each company makes to behave in a certain way until the deal is closed. They cover things like how they'll run their businesses before the merger, how they'll work together to get the deal done, and how they'll try to meet all the conditions required for the merger to go through. It's about ensuring both sides are committed to seeing this through properly. One of the big tasks is preparing and filing paperwork with the Securities and Exchange Commission, or SeeQC. They'll jointly prepare a registration statement on a form called S-4. This document will include a prospectus, which is basically a detailed explanation of the SeeQC shares being offered in this merger. It is crucial for transparency and making sure investors have all the information they need. They'll also file another registration statement on Form S-1 for something called a public offering a separate sale of stock. Additionally, an information statement will be sent to Allegro shareholders to get their approval. SeeQC is also working hard to get its common stock approved for listing on a major stock exchange like the Nasdaq, the New York Stock Exchange, or the NYSE American. This needs to happen around the same time the merger closes. This is a big step towards becoming a publicly traded company that everyone can invest in. They're also making sure to get directors and officers liability insurance, so that if anything goes wrong legally after the merger, the people in charge are protected. Interestingly, Allegro can borrow more money from its own leaders or shareholders to cover its costs before the merger closes. Half of these loans will be turned into Allegro stock at a specific price, and the other half will be paid back in cash. This shows a degree of flexibility and support from those closest to the company. Another interesting point is that SeeQC will forgive all loans made to its insiders and other amounts owed by these insiders. They'll even pay these insiders a special bonus to cover any taxes they might owe because of this forgiveness. This suggests a clean slate approach for the insiders as they transition into the new merged company. Both companies are pushing hard to make a number of things happen before the deal closes. Allegro needs to raise at least $50 million through something called a PIPE, which is a private investment in public equity. This is a crucial funding step. SeeQC, on the other hand, is trying to arrange a committed underwritten public offering, meaning they're getting an investment bank to guarantee the sale of their stock to the public. Both these offerings need to happen around the same time as the merger. When the merger is complete, the board of directors for the new SeeQC company will have 7 members. Allegro gets to pick 2 of them, and SeeQC picks 5. What is notable is that SeeQC can later replace one of Allegro's designated directors, unless it is Eric Rosenfeld, who seems to have a special protected position. This control structure obviously favors SeeQC. Now, no deal is done until all the boxes are checked. These are called conditions to closing. Both sides need to agree that certain things have happened. For example, no government body can issue an order that stops the merger. The S-4 registration statement must be approved by the SEC, and no stop order should be in place. The PIPE investment must happen, and crucially, both Allegro's and SeeQC's shareholders need to approve the merger. There are also specific conditions for each company. Allegro needs to be sure SeeQC's promises about its business are true, and that SeeQC has done everything it agreed to do. SeeQC needs to be sure Allegro's promises are true, and that Allegro has met its obligations. Both sides also have conditions related to no new negative actions or legal problems arising that could derail the deal. A key one is that since a specific date in late 2025, not occurring a material adverse effect on SeeQC or Allegro, meaning something really bad financially or operationally. Of course, things can always fall apart. The merger agreement can be terminated if both Allegro and SeeQC agree to it. Either side can also end the deal if it hasn't been completed by a certain date, usually the end of July 2026, unless they agree to extend it. If a government authority permanently blocks the merger, that is also a reason for termination. And if either party seriously breaches their promises or their truthfulness and can't fix it within a given time, that can also lead to the deal being called off. The information about the subscription agreements is essentially a recap of the PIPE financing we mentioned earlier. Allegro is selling its stock to these private investors for about $65 million at $5 a share. These shares will then turn into SeeQ shares after the merger. The sale is happening under an exemption from typical registration rules because it is a private sale to accredited investors, meaning they're considered sophisticated enough to understand the risks without all the standard public disclosures. Then we have lock-up agreements. These are basically agreements where certain shareholders of both SeeQC and Allegro promise not to sell their new SeeQC shares for 180 days after the merger closes. This is to prevent a flood of selling pressure right after the deal, which could drive down the stock price. It shows a commitment to stability in the short term. There are also SeeQC support agreements and Allegro support agreements. These are commitments from major shareholders of both companies to vote in favor of the merger and related proposals. They're essentially agreeing to support the deal and not to vote for anything that could interfere with it or promote any competing offers. They're also waiving their rights to dissent from the merger, which simplifies the process. Finally, this section lists all the attached documents, which are basically the exhibits that back up everything we've talked about. This includes the merger agreement, the subscription agreement forms of support agreements, and the press release. The asterisk means some attachments were left out, but Allegro will provide them to the SEC if needed. Looking at this filing, Allegro Merger Corp is clearly in the process of a significant business transformation. The merger with SeeQC is set to create a new entity, and the terms outlined are complex, involving stock conversions, splits, and earn-out provisions. The earn-out structure is particularly noteworthy as it directly links future payouts to stock performance, incentivizing management for long-term shareholder value creation. The PIPE financing and public offering are critical to fund the ongoing operations and growth of the merged entity. The governance structure, with SeeQC having more board representation, suggests they are the dominant partner in this merger. The numerous conditions to closing highlight the potential hurdles that could still derail the transaction. However, the support agreements from major shareholders indicate strong backing for the deal. The risks laid out in the cautionary statement are also substantial, covering everything from regulatory issues to market competition and execution challenges for the combined company. Overall, this filing paints a picture of a company poised for a major shift with significant opportunities, but also considerable risks ahead. Alright, that is our deep dive into Allegro Merger Corp. Latest filing. What is your take on this merger and its potential impact on the stock price and future of the company? Drop your thoughts in the comments below. If you found this analysis helpful, please hit that like button. It really helps the channel grow, and subscribe for more of these corporate breakdowns. And remember to join our Discord community linked in the description for more discussions and insights. Thanks for watching, and we'll see you in the next one.